All right, so here we are with Chapter 11, and Chapter 11 is all about S corporations. And this video is designed to be kind of a companion to the Chapter 11 in-class graded problems. What I'll do is talk about some S corporation topics and then go through some problems related to those topics. And then you can use these problems to help you with the in-class graded problems. There are more problems in this PowerPoint or in this video than there are in the graded exercises that need to be turned in. Okay, so here we go. All right, so what I did was kind of broke up this graphic from your textbook, and I thought this was a pretty good chart, and it's also in the notes that I posted for Chapter 11. But what it does, which I thought was really helpful, was it goes through specific tax characteristics, and it compares each entity type. So it talks about C corporations, S corporations, and partnerships and LLCs, and it compares those entities and the requirements related to those tax characteristics. So what I tried to do with the problems was break them up into categories. Okay, so the next group of true, false, and multiple choice problems will be based on these types of concepts. Okay, so the thing that we should point out is when you're forming or contributing property to an S corporation, it functions the same as a C corporation. So typically, there's no gain or loss on contribution of appreciated or depreciated property if, when you transfer the property, you end up having control, and that's the same way that control is defined for C corporations. Okay, the other things that we need to look at are types of owners. Okay, so with C corporations and with partnerships and LLCs, there are no restrictions. However, with S corporations, we know there are restrictions on who can be an owner, and we also know that there are restrictions as far as the number of shareholders. Okay, remember that a C corporation, all right, cannot be an S corporation shareholder. Okay, so that's very, very important to remember. Okay, let's look at our first problem. Okay, so differences in voting powers are permissible across shares of S corporation stock as long as the shares have identical distribution and liquidation rights. Okay, this is true. Okay, remember that in order for you to have an S corporation, you can only have one class of stock. Okay, and differences in voting powers are not a different class of stock. So differences in voting powers are permissible. They're okay. And debt instruments, so bonds, do not typically violate this single class of stock requirement, okay, unless they're treated as equities somewhere else, okay? So remember that for an S corporation, you can have one class of stock, okay, but you can have different voting powers. Okay, so now we come to as far as who can be an owner, can be an S corporation shareholder. Okay, so which of the following is prohibited from being an S corporation shareholder? All right, and I already mentioned this previously. The answer is C. C corporations cannot be an S corporation shareholder. All right. Which of the following is not considered a family member for purposes of the S corporation shareholder limit test? Okay. And so what this is talking about is, remember that you have a 100 shareholder limit, but remember that family members and their estates count as only one shareholder, okay? And family members include a common ancestor with not more than 6 generations removed, okay? So what does that mean? It means that all of these folks can be considered a family member, and the key here was which one of them is not. And so the answer is E. None of those choices are correct because all of those are family members for the purposes of the S corporation shareholder limit test. Okay. So now we get into a situation where we have Tone Loc, and he's got a whole bunch of fans, and they form an S corporation, and they have as the original 90 shareholders. Okay, so he's got Tone Loc and 89 of his biggest fans. That makes 90, right? He then transfers some of his stock to his grandfather, 4 of his cousins, 5 of his children, 3 of his grandchildren, and 2 close friends. Okay, so how many shareholders does the corporation now have? Okay, so what do we know? Well, we know that initially we had Tone Loc and 89 of his biggest fans. Okay, so then we've got Tone, and he transfers to his grandfather, still his family, 4 of his cousins, still of his family, 5 of his children, 3 of his grandchildren, 2 close friends. Okay, so originally we had 90. Now we have plus 2. Oops. Hold on. I got to erase. Need a bigger eraser next time. So the answer is B, 92. Okay. All right, so now we're going to go to kind of a different type of problem, sort of a different section of the material. And so remember, as we're talking about different tax characteristics, with a C corporation, it's a default status, right? When you incorporate and you have, depending on which state you incorporate in, C corporation is default, okay? For an S corporation, you have to formally elect to have a corporation be taxed as an S corporation, okay? And remember that a partnership is also a default status if it's not incorporated, and you must have more than one owner. So if you've got multiple owners and you're not incorporated, you're automatically a partnership. That's very different than an S corporation, because with an S corporation, you have to formally select to be taxed as an S corporation. And we'll talk about, as we go through these problems, some of the nuances with electing that status. All right, so let's first question in this section. So an S corporation can make a voluntary revocation. So an S corporation can voluntarily revoke its S status, or it can do something that is problematic from a qualification perspective, and it can involuntarily terminate its status. But in this situation, if you've got shareholders and they hold more than 25% of the S corporation stock, and they agree, can they voluntarily vote to revoke the S corporation status? All right, and the answer is no, they cannot. So this is false. And the reason that this is false is you need more than 50% of the shareholders to agree. And be careful with that. I said 50% of the shareholders, but essentially it's shareholders with more than 50% of the stock. Okay, so yes, you can voluntarily revoke your S Corp status, but you have to control more than 50% of the stock in order to do it. All right, so this question has to do with terminating an S corporation status, not voluntarily, but as a result of some mismanagement, if you will. Okay, and so this has to do with passive investment income. Okay, and if you remember, I posted a bunch of some Chapter 11 notes, and the excess net passive income is addressed in those notes as well. So let's talk about that a little bit. So this question says, an S election is terminated if the S corporation has passive investment income in excess of 20% of gross receipts for 3 consecutive years. Okay, so this is false. All right, and the reason it's false is because this should say 25% for 3 consecutive years. So remember that the excess net passive income tax applies only to S corporations that have previously been C corporations, okay? And they have to have accumulated earnings and profits from a prior C corporation year. So this only applies if S corp was a C corp and had accumulated E&P from C corp. Okay, and so if the passive investment income exceeds 25% of gross receipts, all right, like it says in this thing, for 3 years, then you have to pay an excess net passive income tax. Okay, so what is included in this excess net passive income? All right, so so it includes royalties, rents, dividends, interest, and this includes tax-exempt interest as well as annuities. Okay? All right, so now we come to when are S corporation elections. So when is that election to be an S corporation effective? So let's take a look at this problem. So we have a calendar year end C corporation, all right, and they were formed January 1st of 2021. And all of the shareholders, so Hassel, Ritchie Cunningham, and Arnold's Incorporated, a C corporation, file a Form 2553 to elect S corporation status on April 14th of 2021. When is this S election effective? All right, and this is a little bit of a trick question, but it's just designed to make you think about shareholders and what would be a valid S election. Okay, so since we have a C corporation as a shareholder, they cannot make a valid S election. So the answer is never. Okay. All right, so let's take a look. So now we've got JD, and they form Clampett Incorporated as a C corporation. And it's a calendar tax year, and they've got JD, Granny, and Jethro, a C corporation, as shareholders. Okay. On January 15th, 2021, Jethro Incorporated sold all of its shares to Jane Hathaway. So the C corporation is selling all of its shares to Jane Hathaway. All right. So on February 28th now of 2021 still, Clampett Incorporated filed an S corporation election with JD, Granny, and Jane all consenting to the election. So they no longer have an ineligible shareholder. All right. What is the earliest effective date of the S election? All right. And the earliest effective date of that S election is going to be January 1st of 2022. And the reason that S election is not effective until 2022 is because in 2021, they still had an ineligible shareholder because for a portion of 2021, even if it's only one day, you can't make a valid S election as long as you have an ineligible shareholder. So their S election is not valid until 2022 since they don't have any ineligible shareholders in 2022. All right, so this is another effective date question. So we've got Annie and Andy, and they each own 30%. Okay. They file a revocation statement on February 10th, 2021 to terminate their S election. All right, what's the effective date of that S election? Or what's the effective date of the termination, I should say. Okay, so a couple of things to note here first. All right, they each own 30%, so that's 60% total. So they can terminate because it's greater than 50%. Okay, but the other thing you have to know is that generally speaking, voluntary revocations made on or before the 15th day of the third month are effective as of the beginning of the year. Okay, so when did they make this election? They made this election February 10th, okay, and that is before the 15th day of the third month, before, I should say, on or before is the rule, but it's made before the 15th day of the third month. So therefore, their election to terminate is effective as of January 1, 2021. Now, had they made that revocation after this time period, then it would not be effective until it would be effective the first day of the next year, or you can specify a revocation date, and as long as that termination date is on or after the date the revocation is made, then that can be the effective date. Okay, so you've got a couple of options as far as revoking your S status. All right, so now let's kind of go back to our chart of comparisons and talk about a couple of different tax characteristics and differences between C corporations, S corporations, and partnerships. Let me see if I can shrink this just a little bit. Oh, there we go. That's a little better. Okay. All right. So income and loss allocations, okay? Obviously with a C corporation, right? They stay at the corporate level. An S corporation is a flow-through entity. It's based on ownership percentages, okay? Notice with a partnership, the income and losses flow to the owners, but they can be allocated based on either ownership percentages or special allocations. There's a lot more flexibility with partnerships. With S corporations, it's based on ownership percentages. Bam. Okay. For what about debt? Okay, entity debt included in the stock basis or partnership interest. For a C corporation, no. What's your stock basis in a C corporation? For a C corporation, your stock basis is the price you paid, right? If you buy IBM stock at $10 a share and you paid $10 a share for that stock, then your basis in that stock is $10 a share, okay? For an S corporation, all right, generally debt is not included in your basis, okay? That's something very different from partnerships, right? So generally, debt is not included in your basis. However, okay, this is an important detail here. Loans made from the shareholder to the S corporation create debt basis, okay? And then losses can be deducted to the extent of stock basis and then debt basis, okay? Remember, with partnerships, the liabilities of that entity do impact the basis of the partners, right? And then losses, okay? Losses obviously remain at the corporate level for a C corporation. Losses flow through, but are subject to tax basis limitations, at-risk limitations, and passive activity limitations, as well as excess business loss limitations, okay? So the loss limitations are very, very similar to partnerships and LLCs, okay? So let's do some problems that relate to these tax characteristics, okay? And I believe this is the largest, this is far and away the largest block of problems. All right, so here we go. All right, so we got Vanessa, and she contributes cash, land with a fair market value of $100,000. Fair market value of $100,000, adjusted basis of $40,000, okay? And the land had a $30,000 mortgage, okay? So the question is, what's your tax basis in the stock, okay? So what do we have to do? Well, we're going to have to add up the value of what she contributed, and she contributed $20,000 cash. Remember, we're talking adjusted basis of the land was $40,000, and then because they relieved her of the mortgage actually reduces her basis. So that leaves a basis of $30,000. And so the answer is B. Okay? All right, so which of the following is not an adjustment to an S corporation shareholder's stock basis? All right, so do we see an increase for any contributions to the S corporation during the year? Yes, we do. Okay, so again, this is which one is not. Okay, so, all right. Do we increase for their share, of ordinary business income? Yes, we do. decrease for the shareholder share of non-deductible items. So this is just like this is like a separately stated item, right? We had fines and penalties when we were talking about partnerships, so that's the same thing. Okay. Increase for distributions during the year. So D would be your answer because you do not increase for distributions during the year. What would you do? Distributions decrease your basis. Okay?